Hello, my name is Mike Higgins. I'd like to thank you for taking some time to learn about our product, Cooperative Clout. It's about helping credit unions to improve their competitive positioning. Now, let's start with a little bit of background. The challenge that credit unions have is unlike other industries where the objective is to maximize our long-term rate of return. As a financial cooperative, we have really a dual mandate. On one hand, we would like to create benefit for our members. In other words, create value for them, which would really mandate that we minimize our rate of return. We take as little profit as possible from members. On the other side, we have an examiner and obviously a duty to stay financially viable, which means we need to take profit from our members or maximize our rate of return. So it creates this dilemma of where do we want to operate on this spectrum. Fortunately, it's possible to do both of those things at the same time. It doesn't have to be a mutually exclusive decision. It's possible to create value for members and have operating muscle, and we'll demonstrate precisely how that happens and show you some credit unions that are capable of doing that. So how do we go about this process of measuring this? Well, what we do is we take NCUA 5300 data, so it's call report data, and rather than building a peer group based upon asset size, which we believe is the wrong question to ask, we think we should be talking about what are the resources that are going into production. Our operating expense, or traditional just day-to-day non-interest expense. And we ask the question, who provided the similar amount of resources? Who deployed that the most effectively and efficiently? And so we end up with a peer group that's really tightly clustered around your operating expense. And I think that's an important distinction and a better basis for comparison. So the first thing that we look at is what we call member value added, and there's two primary areas that we're going to be focusing on. The first one is called productivity, and the second one is pricing. And the neat thing about this is you can really create a virtuous cycle, or maybe a flywheel effect, if you will, because the greater your productivity is, the better the pricing you can provide for your members. And the better the pricing you have, the more market share you can capture to do what? Help become even more productive. So it really creates this virtuous cycle. So in terms of productivity, we're looking at three forms of output. We're looking at what we call loans. We're looking at the true member relationship, what we call relationship shares. Do I have that? The balance of our draft, regular, and money market shares. And we're looking at non-interest income. And we're able to quantify with absolute precision the difference in balance or income that's generated in those three areas, what it monetizes to. And I think that's very important. This is not a subjective exercise, it's an objective exercise. Then we look at dividend rate, we look at surplus funds yield, we look at loan yield, and we look at charge-offs. We're looking at loan yield and charge-offs in relation to each other, the risk-return trade-off there. The interesting thing about the dividend rate and the loan yield is the more dividend that we can provide to members, the greater the value it creates. So that runs contra to return on assets, and the same thing for the loan yield. The more productive we are, we don't have to take as much yield from our members to be financially sustainable. And again, with each of these areas, we're able to compute with absolute precision the difference in the performance versus the peer and what that monetizes to. As a matter of fact, in this example, here's a credit union that holds more loan balance than the peer group. Over the prior year, the same time period that we're looking at expense, it held $93 million more loan balance. We're able to monetize that was worth $3.1 million of value added, because those balances, had they not been sitting in loans, would have earned the investment yield and reduced income of the credit union by $3.1 million. We do the same type of analysis for the rest of the categories. We're able to monetize the difference and come up with an overall member value score, and then we're able to percentile rank that. So this credit union in this illustration generated about $6 million more value than the peer, and that's a great demonstration of effective deployment of resources. So the next thing we look at is called operating muscle. And operating muscle is really comprised of three primary areas. Obviously, the ultimate measure of muscle is the ability to generate a rate of return, a bottom line return on assets. But more importantly is how that is generated, because there's certain ways that you can generate ROA that the competition can't take from you, and there's other ways it can, and we'll touch on that in just a minute. And then the last element is how much reserves or dry powder do we have to absorb losses or economic shock, or provide ability to support rapid growth should an opportunity present itself for that. So with each area, we have an analysis that we look at. We look at rate of return, which is the bottom line muscle that we're creating. But we also want to look at the top line, because that's really where the first sign of trouble shows up, given that this is a fixed cost industry. We look at productivity, which your competition can't take from you. We look at the depth of the member relationship, because cost of acquisition is so high. And again, that's something it's very hard for the competition to take from you, because deep relationships usually signal strong affinity. And then we look at knowledge, skill, and ability, the strength of the product mix. How are we utilizing the capital? How strong is our balance sheet on the asset side, the liability side, and then how much are we able to offset our non-interest expense by generating income from the non-interest side, which reduces strain on net worth and reduces reliance upon margin. And then we look at capital adequacy as well. So again, we would take a look at each element of performance over the prior year, and we would benchmark that against the peer group. The neat thing about the analysis that we provide as well too is you're able to see who does it best and why. I've always been frustrated with analysis that is what I call data. It's just numbers. We want to provide you with information so that you can glean some insight in a very efficient manner. And then again, we're able to look at each category and then see how you percentile rank against the peer group, and then help to make some recommendations and some suggestions that would improve the operating muscle. Again, in this illustration here, it looks like we've got some opportunity in terms of productivity and product mix that would improve the rate of return, which would drive up the operating muscle. So in terms of combining these together, we call that cooperative clout. And we define that as the ability to create value for members in a financially sustainable manner. So on one axis, we have operating muscle. On the other axis, we look at member value added. And we break the quadrant or the chart down into 4 quadrants. The first quadrant in the top right is what we call the top quadrant. And these are credit unions that are doing both of these things at the same time. So this isn't just credit unions are rumored to do this. We can actually identify who that is and what their traits and characteristics are. And the beautiful thing is they have a competitive advantage. They have a superior ROA, and they're creating more value for members at the same time. So they're best to fend off competition and endure economic disruption. Those credit unions that find themselves in the muscle quadrant, they're obviously flexing that. They're doing a great job there. But the thing they got to watch out for is if they're generating that muscle and not creating value, and they're doing it because they're taking a high net interest margin from their members, that creates opportunity for the competition. As Jeff Bezos was famously quoted as saying, "Your margin is my opportunity." The lower left-hand corner we call the constrained quadrant. It's a highly regulated industry, so if you're operating here, that doesn't mean you're going to fail, but you have a challenge because your weak muscle is making it difficult to provide capital for growth, to invest in the cooperative, and we don't have much of a value proposition to sell to the marketplace. How could we work on improving that? The value quadrant is the upper left-hand one. This is where credit unions are creating a lot of value for their members. They're returning it back to the members, but we want to make sure our muscle is not too weak because we need to grow to offset our increasing cost of operations and to make investments in the cooperative to maintain market relevance. So these are how the 4 quadrants are defined. In each one of them, there's a general overall strategy. If you're in the upper right-hand quadrant, celebrate that. Sell that how you're different to the marketplace. But be aware there are larger competitors on the horizon, so we really need to avoid complacency. Lower right-hand quadrant, what do we want to do? Take some of that muscle. Maybe we can use it to add value. If we're in the value quadrant, can we use some of that to build some muscle? And if I find myself in the lower left-hand quadrant, is it possible to start to make a progression to migrate, if you will, northeasterly, improving a little bit of those at the same time? So Given the peer group we've defined, we're able to see where you stack up. We're able to see where your competitors in the credit union world stack up as well too, where they are positioned. And then you can start asking questions. What would we like to do about that? The tool includes a planning module where you can provide some inputs in terms of expense growth and in terms of revenue growth, and see if you're achieving scale as you're growing. Are we getting economy of scale? You can drop in some rate assumptions, the same thing for credit losses and reserves, and see how that affects the income and your net worth ratio, and then where your positioning would improve to over the next 5 years. It produces a full set of financials into a formal financial plan, balance sheet, income statement, rate assumptions, net worth, all the key ratios that you need to look at. And then you can use that as a tool to build your strategies. I've always felt that it's best that we visualize where we want to exist and the benefits of doing that, then understand financially what do we have to do to get there, and then drive toward the strategies and tactics and action plans that are going to push you along that path. At some point, strategy and financial reality have got to intersect. I'm of the school, let's talk about where we'd like to see ourselves and then work our way back into that. So that's Cooperative Clout. Thank you for taking some time to learn about the product today, and we'll look forward to hearing from you.